Okay, good evening, everyone. Today we're looking at performance management (PM), and we'll continue from our last week topic, which is the introduction to capital appraisal. Then today we're looking at the taxation and inflation effects on appraising a project. So we want to look at the effects of taxation. That is when you want to calculate tax, because tax is a um, relevant cost, as long as it's because it warrants the payment of cash. That's why we say tax is a relevant cost. Now we want to look at inflation. When we say inflation, we want to look at how will inflation, because when you want to appraise a project normally takes more than 1 year, that is 5 years, 3 years. And remember that the inflation in year one will not be the inflation rate in year two. So what will be the fate of the appraiser when they foresee there will be an increase or decrease in inflation rate? So we want to look at these two major items in investment appraiser, because in May 2016 I can set a question on inflation and taxation on investment appraiser. So that question will be an assignment to us. So I want us to solve it. Then when you solve it, then I'll send us the solution. Now, also, taxation cash flows in investment appraisals. In project appraisal, tax is irrelevant cash outflows, which should be factored in the project appraiser decision. As I will say, you should always factor tax in the project appraiser. Tax cash flow should be included in DCF analysis. So let's look at the timing of the cash flows for taxation. The timing. Also timing. How do you pay tax? Remember in taxation. Okay, remember in taxation, how do we pay tax? Tax is always paid on a preceding year basis. So if there is no information on how to pay tax, the timing. So the tax of when you calculate the profit of year one, the tax on the year one should be paid in year two. Tax of year two will be paid in year three. That is, but where the question stipulates how the tax should be paid, then you have to follow the question. But let's read from the notes. We said the actual timing of tax payment depends on the tax rules that applies in the relevant jurisdiction. So Nigeria is on the preceding year basis. One or other of the following assumption is used. The tax is payable in the same year as the profit to which the tax relates. So this is the actual year basis. That means if the project is a business, that was a commerce, so you can follow the tax rule. While the other one is a preceding year basis. Now let's look at the interest cost and taxation. Yeah, what is interest cost? The interest cost and taxation. The interest cash flows are not included in the DCF analysis. This is because the interest cost is in the cost of the capital. So the interest cost is not included in the DCF in calculating your in appraising the project. So the interest cost, because it's already inculcated in the cost of capital. So that's why interest cost is not there. But when it comes to debt, we normally use, when we want to calculate by giving the cost of debt, and we can use the cost of debt to use to appraise the project instead of using cost of capital. They can say cost of debt. Now that cost of debt is what we use to appraise the project if there is no cost of capital. So you can use cost of debt. Now using cost of debt, and we are told that there will be tax. That tax, the tax rate, you must look for post-tax cost of debt before you now look at a punch calculator to look at the DCF for that post-tax cost of debt. Now when there is tax, there must always be capital allowance, which is a tax allowable depreciation. So when there is tax, there's only be capital allowance. So in your question, you might be giving a depreciation for the project, because we say project will cost 500 million, it will take 5 years. Now that depreciation will factor in calculating your profit normal. Then after that, you have to add back that depreciation and deduct capital allowance before you now arrive at the cash net cash flows to appraise the project. Now, all I was saying, the nature of capital allowance: when the business buys a non-current asset, depreciation is charged in the financial account. However, depreciation in the financial account is not an allowable expenses for tax purpose. As I've said, it's not allowable expenses for tax purpose, so you have to add it back. Instead, the tax rule provide for tax allowable depreciation or capital allowances according to the rules determined by the government. So normally we have two major way of allowing for depreciation or for tax purpose. They can give us in a question and said the capital allowance should be on a straight line method. So you use the straight line method, they will give you a cost. So you use the straight line method or a reducing balance method. So you will use either of the two, reducing balance method. Now, what is balancing charge or balancing allowance on disposal? You were told in a question that at year 5 or year 4, which is the concluding part of the project, that the non-current asset will be disposed. That will give you the resale value. Now that resale value, we should look at it in line with our tax written down value, if it's higher or lower. So that will allow us to know what is the meaning of balancing allowance and then balancing charge. So now let's discuss balancing allowance. Balancing allowance, when the written down value of the asset for tax purpose is higher than its disposal value, that is balancing allowance. When we say balancing allowance, we are saying it's an additional income, whereby when the written down value of the assets, that means the cost minus capital allowance is what? Written down value. Now when that value is not higher than the received value, then the difference is called balancing allowance. Another balancing allowance is an additional income. Now it will come as what? As income in your analysis of a DCF. It will come as income. So that income will now discount the income in that year of disposal. If it's year 5 or year 4, you discount the income in the year of disposal. Now balancing charge. Now this balancing charge is when the tax written down value of that asset is lower than the disposal value. Now when you look at the cost minus the capital allowance is your tax written down value, then when it's now lower than the disposal value, than the resale value, and once you dispose the asset at the end of the useful life of that asset, then that is the balancing charge. That is an additional expenses in your investment appraisal. So it's an additional expenses, so you must bracket it. It will be an outflow in year 5 or the year 4, if the year 4 is the ending part of that non-current asset. So here we said the balancing charge is a taxable amount and will result in an increase in tax payment. Increase in tax payment. So let's look at DCF and inflation. Now there is inflation. How will inflation affect at our project? Inflation and long-term project. When a company makes a long-term investment, there will be cost and benefit for a number of years. In all in all probability, the future cash flows will be affected by inflation in sales price, and inflation in cost. DCF analysis should take inflation into account. There are two ways of incorporating inflation into DCF analysis. A company should either one, discount the money cash flows at the money cost of capital. Now, when we say money cash flow is the inflow or outflow of cash in an economy where there is no inflation. That means no inflation. When there is no inflation, we want to look at what is the value, and when you get the money cash flow, you must discount the money cash flow with money cost of capital. They are like things. You don't discount cash flows with money cost of capital. It must be money cash flows and money cost of capital. And then discount the real term, which is the real cash flows at the real cost of capital. When we say real cost of capital, we are talking about the cash flow that currently today where there is inflation. That is your current cash flow. You are told that there will be inflation, so that money during that period is real cash or real money. That money has already inculcates inflation rate. Now already get inflation rate. So if that is understood, then you have to now, if you are giving the money cost of capital, you have to convert the money cost of capital to real cost of capital. Now, what is real cost of capital or real rate of return? Real cost of capital, or you say real rate of return, they are the same thing. Real cost of capital is the return that investor will require without inflation. Real terms cash flows are what an item would cost or be sold for in the current price. So in the current price. Now, what is money cost of capital or money rate of return? Money cost of capital is the return that the investor will require with inflation. So if you are giving the cost, okay, what is the cost with inflation? So you have to add inflation, because inflation increase cost. Remember that inflation increase cost. That means money cash flow will be higher than real cash flow. So if you are giving real cash flow, you must multiply it with the inflation rate to get the money cash flow. It follows that the money cost is higher than the real cost in terms of inflation. Money cash flows refers to the amount that is actually received or paid at a different point in time in the future, taking into account the money cash flows. The money cash flows are estimated by initially pricing cash flows at current price and then inflated them by the expected inflation rate. Now, how do you get your money cash flow or your money cost of capital? Now, if you are giving the money cost of capital, which is the return itself, if you are giving the real, then we'll say the money cash flow, which is the M, equals to 1 plus the real cost of capital. 1 plus the real cost of capital times 1 plus inflation. So if it's year one, then it will be raised to power n. So if it's year 2, it's raised to power 2. Where m is always the money cost of capital and r is the real cost of capital and I is the inflation rate. I is the inflation rate. Now if you want to look for the money cash flow, it will be the real cash flow times inflation rate, 1 plus inflation rate. So of each year, that's 1 plus inflation rate. Now let's look at this illustration. A company is considering an investment in an item of equipment costing 150,000 naira. The equipment will be used to make a product, so we need a product. The selling price of the product at today's price would be 10 naira per unit. Selling price is 10 naira per unit, and the variable cost per unit, all cash cost, would be 6 naira. The project will have 4 years, and sales are expected to be followed. So this unit to be sold. We are told that at today's price, it is expected only at today's price. Today's price means what? They are real price or real cash flow. It's expected that the equipment will be sold at the end of year 4 for 10,000 naira. There will be additional fixed cash overhead of 50,000 naira each year as a result of the projects at today's price. So you are told that today the project there will be 10,000 naira. They will sell the project the equipment at the end of year 4 in 10,000 naira. So we are giving inflation for sales is 5%, for variable cost is 8%, fixed cost is 8%, and equipment disposal value will be 6%. So you are giving the money cost of capital, which is what? 12%. Now we are asked to calculate the NPV of the project. Here, the NPV of the project. Here we are giving the money cost of capital. So we will use the money cost of capital which is 20%, as our discounted factor. So now solution. The solution for this question, when you look at it, we are giving the money cost of capital, which is 12%, and we are giving the cash. All these cash are real terms. Today current price, which is today's price, they are real cash flows. What we have to do is to convert the real cash flows to the money cash flows, because we are giving money cost of capital as the cost of capital for this project. So when we use 12%, then our workings, the first thing is our sales, our revenue. Remember that our cash inflows is our cash profits, and we are told that all items are cash basis. So we look for the sales, which is the revenue. Now the revenue, we are told that year 1 the unit will be 20,000, 40,000, 60,000, then 20,000. We are told that the selling price is 10 naira per unit, and the sales will be 200,000, like as follows. Now our inflation, because we want to look for the money, and we are told that money cash flow will multiply our real cash flows times the inflation rate to arrive at the money cash flows. Now the cash flow for year 1 will be 1 plus 5%, which is our what? 1. So doing so rather, we have 210,441,000, then 694,575, and 243,101. So this is our revenue, our money revenue. Next is our variable cost. So our variable cost is we are making variable cost per unit, which is 6 naira. And if it's 6 naira variable cost per unit for each year, so year 1 to year 2, year 3, and year 4 is 6 naira. So our variable cost now is 120,000 for year 1. Then this variable cost is real cost, so we have to multiply with inflation to get our money cost. So when you multiply with inflation, you have our variable cost to be 129,600 for year 1. Then for year 2, 279,936. But our fixed cost is fixed, so it does not vary. So our fixed cost for year 1 to year 4 is the same thing, which is 50,000 naira. 50,000 naira. But we are giving inflation rate to be 8%. So when you multiply the 8% of the inflation rate plus 1 times the 50,000, we have 54,000 for year 1. Then for year 2, year 3, and year 4. So these figures are our money cash flows, and we are told that there will be adjustment will be disposed of in year 4 now, which is 10,000 naira at today's price. Today's price means at real cash flows or at rich cash. Now to solve for the money cash flow is that you have to multiply the 10,000 naira times 1 plus inflation raised to power n, which is which year are they disposing it of? Year 4 raised to power 4. Then we have 65,536. So this is the summary of our net cash flows. So the net cash flow for year 1, for year 2, year 3, and year 4. You now have to, now in our analysis to appraise the project, you find that the money cost of capital is 12%. So you find that our money MCC is 12%. So you look for project calculator, you say year 1 the DCF is 0.893. So our NPV is 97,809 naira. So it shows that the project is viable because it's positive. So the decision is that the company should accept the project, should go ahead and accept the project because it's positive, which is viable. Now let's look at illustration 2. This illustration 2, we have to calculate our NPV using the money cash flows and the money cost of capital, then using the real cash flows and the real cost of capital. Now when we have to do this money cost of capital, when you calculate NPV using these two different items, our answer will be the same thing, and the answer in money will almost be the same thing with our answer in real cash flows when you use the real capital to appraise the real cash flow, because it will give us the same answer. Now when we say today's price is the real, all these figures they are real cash flows. So we have to convert the real cash flows to money cash flow. So yeah, we are giving our sales, so our contribution per unit, which is 20,000 which is 20,000, which is the unit times 4 naira. So when you multiply 4 naira with 20,000, you get 80. 4 naira times 40,000 units, you will get 160. Then 4 naira times 60,000 units, you will have 240,000 naira. Then 4 naira times 20 units, you will have 880,000. And our fixed cost is flat, which is 50,000 naira, and our disposable value is 10,000 naira in year 4, so which we are told is year 4. So by the time you look at this, you find that our net cash flows at the list price is 30,000, 110,000, 190,000, and 40,000. Then you multiply it. When you multiply it with the inflation in year 1, we have this. Inflation in year 2, that means 1.06 raised to power 2. Sorry, it's not 62. It's raised to power 2. It's raised to power 2. Then times 1.06 raised to power 3 times 1.06 raised to power 4 raised to power 4 raised to power 4 times 40,000. You will have this. So it's not 0.62, it's 0.6 raised to power 2. So we now have our NPV under money cash flows. Under money cash flow will be 148,891 naira. Remember that our money cost capital is 15%, while our cash flows is 150, which is the initial, and the net cash flows from our workings is 31,800, 120,596, and so on. So with this, under our money cash flow for NPV, the project is what is viable. Now for cash flows and cash capital, you must convert the money cost of capital, which is the 15%, to the real cost of capital. That is the first thing you have to do. So doing that, the workings is from our formula above. That is why I change the subject of the formula to R equals to 1 plus M over 1 plus I, which is inflation, minus 1. So we have 0.085, which is 0.8.5% as the real cash flow, like what you use to discount the project. Now we are told that these figures are today figures. And I always say today figure means and we are told that there is inflation in year 1. That means that figures is already the figure is already during the time of inflation. So they are real cash flows. So you don't have to increase them again. So you have to limit it, must be that's the real cash flow. So the figures are all put here. That means we have the net cash flow, which is today's price, which is today's price is our real cash flow. That is what we put there. Then we find that we also have 148,706. So the difference here is just approximation error. It's approximation error. It's not significant. It's not significant. Yes, now here this is an assignment. So I want us to solve this as an assignment, and by tomorrow I want to see our solution. So you should send me our solution. Send the solution to my WhatsApp account, my WhatsApp number. So let me review it. Then I will also send you the solution. So I want to see if you actually lay your hand on it. So anybody that solve it and send me the solution, I will send the person the solution to the assignment. And if there's any question, you must ask me question on your own workings, not asking me question on everything on your own workings. Then, so by tomorrow or first thing next tomorrow morning, I will send the solution to the group. But before then, send me the solution to my WhatsApp, and I will send you the answer. So we are done with discounted factor, which is to beta appraisal. Now, as a topic under PM, which is risk and uncertainty. So we want to look at how risk of uncertainty affects our capital investment appraisal. What if? It's called what if analysis. So there is probability. You are not sure of the figure of the estimate you are giving. So it's you are not sure. Then if you are not sure, you must look for the probability. Then before appraise the project, you now look for the expected value. Expected value that was used to appraise the project. Expected value that we want to appraise the project, because you don't have a specific value, you are not sure. So you have a probability that this is what will happen. So that is what we use to appraise the project. So I will not complete this because it's a topic that will be treated by my colleagues. But before that, I want to give us a brief understanding of the topic. It's a topic that is bigger than this. So then you do simulation and the rest. The problem of risk and uncertainty in investment projects are long-term projects, often with a time scale of many years. When the cash flows for an investment project are estimated, the estimate may be incorrect. Estimate of cash flows might be wrong for two main reasons. One, risk in investments, and two, uncertainty about the future. So what is the risk? So on our experience, risk exists when the actual outcome from a project would be any of several different possibilities, and it is not possible in advance to predict which of the possible outcome will actually occur. So that is the risk. Well, uncertainty exists when there is insufficient information to be sure about what will happen or what the probability of a different possibility outcome might be. So before our time, we have to read up this sensitivity analysis, the method 1 and method 2. Then next class, or I will explain it and send us the solution to this assignment also. So though assignment is very simple, just to increase the or lower the revenue then compute the NPV, increase the revenue, sorry, lower the revenue, then compute the NPV to see if it will still be positive. That is, but these notes you have to read them up and ask me any question. Thank you for your time. Good night.